I want to ask you a question, and I really want you to be brutally honest with yourself here.
Oh, this is going to be good.
Yeah. Well, listen. Is Broadcom ticker symbol AVGO? Is it an unstoppable AI powerhouse just, screaming toward $500 a share? Or, and hear me out on this, is it quietly flashing these massive sell signals? Like setting up a brutal trap for retail traders right as it hits its all-time highs.
Man, that is, I mean, it represents the ultimate dilemma in the market right now, doesn't it?
Right.
Because we are watching this undeniable, just generational technological momentum crash headfirst into some highly, highly concerning market psychology.
It really is.
Yeah.
Because let's look at the reality on the ground today, right? It is April 15th, 2026. Broadcom just closed the trading session at $396.72.
Yeah.
It gained over 4% in a single day. And it is knocking loudly on the door of its all-time high, which is 1461.
Which is wild.
But here is the context that should literally make the hair on your arms stand up. Its 52-week low is 161.61. So we are not just talking about growth here. We are talking about extreme, violent upward velocity.
Yeah, and that kind of vertical movement is precisely what makes the current setup so precarious,
Exactly.
Because when a multi-billion-dollar company more than doubles in a single year, that margin of safety, it just disappears entirely.
Which is exactly why we need to tear this apart today. We are going to look under the hood of Broadcom's financials. We're going to analyze the actual chart data, and this is the crazy part track where the insiders are moving their money.
Right, the insider activity is key here.
It's massive.
Yeah.
We need to figure out if this AI darling is fundamentally undervalued based on its growth trajectory, or if it's a highly dangerous value trap just waiting to spring on the everyday investor.
Yeah, a lot to unpack.
A ton. And real quick, before we pull up the balance sheets, please hit the like button, subscribe to the YouTube channel, and drop a comment below. We really want to know if you are buying this rally, or if you're just sitting on the sidelines.
And please remember, as we debate these numbers today, this deep dive is an objective look at the source material for educational purposes only, right? This is absolutely not financial advice.
Definitely not. So let's start with the concrete reality of the business. I mean, from 161 to nearly 400 a share. How did they actually get here?
The fundamentals, right.
When you look at their trailing 12 months, their total revenue sits at $68.28 billion.
Massive.
Yeah, which translates to a net income of $24.97 billion, with earnings per share sitting at $5.12. But the metric that really just jumps off the page for me is the free cash flow.
Oh, yeah.
They are generating a monster $25.5 billion in free cash flow.
And that cash flow is, well, it's the engine of the entire bullish thesis, really. But it's the efficiency of that engine that requires an explanation, because Broadcom is operating with a 39.89% operating margin.
Wait, almost 40%.
Nearly 40%. And in a business that involves designing physical hardware like complex silicon networking chips, that level of profitability is just, it's an anomaly.
Let's put a pin in that 40% margin because I think it's vital. Imagine like a highly efficient, incredibly popular restaurant, right?
Oh, like this.
Usually restaurant margins are razor thin. But imagine a place where for every $10 a customer spends, the house keeps $4 as pure profit.
Wow, yeah.
Right. After paying for all the ingredients, the staff, the rent. The only way a restaurant pulls that off is if they own the exclusive rights to the most addictive, sought-after ingredient in the city, and literally nobody else is allowed to grow it.
That's a great way to put it.
That is essentially what Broadcom is doing with their intellectual property in the networking space, but, on a scale of tens of billions of dollars.
Exactly. And the pricing power stems from the fact that switching away from Broadcom's infrastructure is, well, it's prohibitively expensive and technically terrifying for massive data centers.
Right. Nobody wants to unplug the whole system.
They don't. They have their clients completely locked into an ecosystem.
I hear that, but look, I'm looking at their balance sheet as of early 2026. And I see a massive vulnerability staring right at me.
The debt.
The debt. They have $171.09 billion in total assets, sure. But they are carrying $65.14 billion in total debt.
Yeah, it's a big number.
It's huge.
Yeah.
Their net debt is $48.96 billion, which pushes their debt-to-equity ratio up to 82.70%.
Right.
In a world where interest rates are a constant headwind, Rolling over that much debt is going to eat directly into that beautiful free cash flow we just talked about.
Right.
I mean, how does an 82% debt-to-equity ratio not act like a ticking time bomb and threaten those 40% margins?
Well, because corporate debt at the mega cap tech scale, it operates very differently than personal debt.
How so?
That 65 billion wasn't borrowed to just, keep the lights on. It was strategic leverage used for massive acquisitions, most notably VMware.
Right, that was a huge deal.
Exactly. When a company generates over 25 billion in free cash flow annually, a 48 billion net debt position can theoretically be wiped out in 2 years if they just halted all other spending.
But they wouldn't do that.
No, of course not. But the point is, the debt is financing the exact acquisitions that are creating that massive cash flow in the first place.
Wait, I have to push back there. You can't just brush off 65 billion in debt by saying they could pay it off in 2 years because, like you said, they absolutely won't do that.
Sure.
They need that cash to fund research and development. Otherwise, Nvidia or AMD just comes in and eats their lunch. If debt servicing costs rise, that absolutely impacts their bottom line.
That's a fair point. But the cost of servicing that debt is already baked into the current net income figures we just discussed.
Okay, fair enough.
They secured much of that debt before the most aggressive rate hikes anyway. The focus for institutional investors isn't really the size of the debt. It's the quality of the assets that debt purchased.
Meaning VMware.
Yes. Integrating VMware gives Broadcom a massive recurring software revenue stream. Because hardware sales are notoriously cyclical, right? They boom and they bust.
Yeah, feast or famine.
Exactly. But software subscriptions are sticky. They bought VMware to cushion the blow of those inevitable hardware down cycles.
Okay, so they bought a shock absorber. I get that. But let's look at the actual road they're driving on right now. Where's the aggressive growth coming from? Why are analysts projecting Broadcom will hit $100 billion in revenue by 2027?
Well, the acceleration is almost entirely anchored to the infrastructure of artificial intelligence.
Right, the AI boom.
Broadcom recently secured an extension of their AI chip and networking deal with Meta, extending all the way through 2029.
Wow, 2029.
Yeah, we are talking about guaranteed massive scale revenue from literally one of the biggest tech companies on Earth.
And we really need to be specific about what they are actually selling to Meta, because these aren't just off-the-shelf Nvidia GPUs, right?
No, not at all. Broadcom dominates the market for custom AI silicon, which are known as ASICs, application-specific integrated circuits.
ASICs.
Yeah. Think of it like this. Nvidia makes an incredible general-purpose AI chip. It's essentially a really powerful Swiss Army knife.
Okay.
But when Google is running trillions of search queries or Meta is training its specific Llama AI models, using a Swiss Army knife is terribly inefficient, and it consumes monstrous amounts of electricity.
So they need something better.
They want a highly specialized scalpel designed exclusively for their specific algorithms, and Broadcom builds those custom scalpels.
That's a brilliant way to put it. So they have this incredible moat. But let's look at the bear case for a second, because the valuation here is just staggering.
It's very high.
The price-to-earnings ratio, the PE, is currently sitting between 75x and 77x. Plus, their customer concentration is honestly kind of terrifying.
Heavy reliance on just a few players.
Exactly. They rely almost entirely on a few hyperscale clients.
Here.
Google, Meta, and Apple. Think of a freelance worker who makes, I don't know, an incredible salary, right? They look super successful.
Sure.
But 90% of their income comes from just 3 massive clients. If even one of those clients decides to walk away, the entire financial house shakes.
And that vulnerability is very real. I mean, Apple has been trying to design its own Wi-Fi and Bluetooth chips internally for years just to cut Broadcom out of the iPhone.
Right, they want on the whole stack.
Exactly. If Apple finally succeeds, or if Meta decides to pivot its data center architecture, Broadcom's revenue projections would shatter overnight.
And there is a mathematical paradox here that nobody seems to want to talk about in the bullish circle.
The margin issue.
Yes. The source material highlights this sneaky little detail regarding margins. Those custom AI chips they are building for Google and Meta, those scalpels that are driving all this future growth, they actually carry significantly lower gross margins compared to their standard software and networking products.
It's true. The hyperscalers have immense negotiating power. Google knows Broadcom needs the volume, so Google negotiates the price of those custom chips down.
Okay, so you are dodging the mathematical paradox here. Because if their absolute fastest growing segment, The custom AI chips is also their lowest margin product. Maintaining a 40% overall operating margin is physically impossible as they scale.
Mathematically, yes, it gets harder.
As custom chips become a larger percentage of their total revenue, the overall margin mathematically has to shrink. So how can the market justify paying a 77x multiple for a company whose profit margins are structurally designed to compress over the next 5 years?
Well, you've hit on the fundamental risk of growth investing at historical highs. Paying $77 today for every $1 of earnings. It means you are pricing in absolute, completely flawless execution.
No room for error.
Zero. The market is assuming the high-margin VMware software revenue will grow fast enough to offset the margin compression from the custom hardware.
That's a huge bet.
It is. If that balancing act fails, a 77 multiple leaves absolutely zero room for error. If growth slows by a fraction of a percent, the multiple will compress to 40 or 30, and the stock price will crater, even if the company is still technically growing.
That brings up the most glaring contradiction in our research today, because we have this fundamental tug of war established, right? If the valuation leaves no room for error, we have to ask, who is actually making that bet right now?
The smart money versus the insiders.
Exactly. When we look at Wall Street, the analysts are almost comedic in their optimism. Out of over 22 analysts covering a stock, 95% rate it of a buy or a strong buy.
Yeah, very bullish.
Their price targets average between $464 and $474, with some high estimates reaching all the way up to $582.
And the institutional sentiment totally mirrors that optimism. Hedge funds have been loading up, adding 1.9 million shares in recent quarters. The institutional money is just flowing heavily into the stock.
Well, wait, let's unpack this glaring contradiction. Look at the internal data. We have a massive negative signal flashing bright red. Wall Street analysts are screaming buy, hedge funds are piling in, but the people who actually run the company are unloading millions of dollars of their own stock right now.
The insider selling is definitely noticeable.
Noticeable. The president of Broadcom just sold $2.96 million in stock on April 15, 2026. Right as the stock hits these current highs, the CFO and other executives were also actively dumping shares between 318 and 370 throughout March and April.
Yeah.
The people building the chips are taking their money out of the casino, while the analysts are telling you to put your life savings on black.
Look, analyzing insider selling requires separating structural market mechanics from executive psychology, right?
What do you mean?
Well, institutional optimism from hedge funds is largely driven by the macro AI darling narrative. A fund manager who is benchmarked against the S&P 500 literally cannot afford to miss the AI rally.
They have to buy it.
Exactly. If they don't own the infrastructure providers like Broadcom and the sector surges, they lose their jobs. It is institutional FOMO, fear of missing out. They are forced buyers.
The insiders aren't forced to do anything.
Right. Now, insiders sell stock for various reasons: tax obligations, diversifying their portfolio since their compensation is heavily stock-based.
Sure, that's standard.
However, the timing is what matters here. When you see a cluster of C-suite executives, including the president and the CFO, selling millions of dollars of stock right as the price approaches all-time highs, and the PE ratio stretches to 77.
Yeah, it's a red flag.
It tells you they recognize the valuation is historically stretched. They understand the margin paradox we just discussed better than anyone. They are smartly taking profits off the table and systematically locking in their generational wealth while the market is in a state of euphoria.
Right, so if you're a listener watching the insiders cash out while analysts scream buy, your immediate thought has to be, am I walking into a trap here?
It's the logical question.
If you buy today at 396, are you the retail trader holding the bag? Let's look at the technical analysis to see what the actual chart data is signaling for the immediate future.
Okay, let's dive into the charts. The primary trend direction is undeniably bullish. The momentum indicators show sustained buying pressure.
Okay.
Look at the MACD, the moving average convergence, divergence. It measures the relationship between two moving averages of the price, essentially acting as a speedometer for the trend. Currently, the MACD is highly positive, sitting between 8.39 and 9.16.
So the car's moving very fast. But is it about to run out of gas?
That's the question.
Because the current price right now is $396.72. But the moving averages show us just how violent this upward velocity has been. The 20-day simple moving average is way down at $321.84.
Right.
The 50-day is at $326.12. And the 200-day SMA is all the way down at $328.94.
Massive gap.
Think of the 200-day moving average like the stock's center of gravity.
Mm.
Right now, the price is floating way up in the stratosphere at 396. The further it gets from that 328 center of gravity, the harder gravity is going to pull on it to snap it back to reality.
And the oscillators confirm that gravitational pull is imminent. We are seeing major short-term weakness and overbought signals beneath the surface.
Like what?
Well, the RSI, the Relative Strength Index, measures the speed and change of price movements on a scale of 0 to 100. It is currently flashing a bright warning sign, sitting between 70.96 and 74.66.
Break that down for the listener. Explain how that RSI actually functions in the real world. Why does a number over 70 matter?
Think of the RSI like a group of buyers sprinting up a really steep hill. An RSI over 70 means the buyers have been sprinting for a long time, spending massive amounts of cash to push the price higher.
Okay.
Eventually, they simply run out of breath, meaning they run out of new cash to deploy. The momentum stalls, the sellers step in, and the price has to pull back or consolidate sideways just so the buyers can catch their breath. This strongly suggests the stock is exhausted in the short term.
And they are sprinting directly into a brick wall right now.
They are.
Heavy resistance sits right above current levels, specifically at the all-time high zone of 412.98 to 1461.
Very tough ceiling.
If the buyers run out of breath and it gets rejected at that ceiling, the downside risks are steep. Support waits all the way down at the 377.31 pivot. And if that floor breaks, it's a long drop down to the 50-day moving average at 331.02. So I'm going to force you to answer the ultimate question here for the listener. We laid out the $100 billion revenue projection for 2027. We laid out the 77 multiple, the overbought RSI, and the insider selling.
Right.
Is Broadcom currently undervalued based on the AI supercycle, or is this a textbook classic value trap right now for the retail investor?
The answer is entirely dependent on your time horizon.
Okay, explain.
If you are a short-term trader buying today at 396, hoping for a quick, easy pop to 450, you are walking blindfolded into a highly dangerous environment.
Wow.
The technicals that overbought RSI, the massive distance from the moving averages, and the heavy overhead resistance all point to a high probability of a short-term pullback. You very well could be the retail trader holding the bag for the next few months as the stock painfully digests these massive gains. In the short term, it behaves exactly like a trap for the impatient.
But what if someone is looking 5 years down the road?
Long term, calling it a trap ignores the fundamental reality of the data center rollout. If you believe the structural shift toward custom AI silicon is a decade-long supercycle and that Broadcom hits that $100 billion revenue mark by 2027, well, then a PE of 77 today might actually look incredibly reasonable in hindsight.
That's a wild thought.
The underlying business, the monopoly on high-end networking and custom ASICs, is fundamentally exceptional. It is just the premium price you're being asked to pay for it today that requires extreme caution.
So if we zoom all the way out and look at the whole board, we essentially have a classic collision between turbulent, exhausted short-term technicals and an undeniable long-term macroeconomic thesis.
That's the perfect summary.
In the short term, expect extreme volatility. We are highly likely to see the stock take a breather, maybe experience a painful downward correction as it battles that 414 resistance level and tries to cool off that screaming RSI.
Yeah, and in a worst-case short-term scenario, we see a continuation lower toward that 330 support zone. But the best-case recovery scenario for the long term keeps the win firmly at its back.
Because of the fundamentals.
Right. The meta deals, the Google custom silicon dominance, the massive VMware cash generation, those structural advantages are securely in place.
It really all comes down to how much risk you are willing to take on at these elevated levels. Which brings me to a final provocative thought I want to leave you with today. Something to mull over on your own after you close this video.
I like where this is going.
We spent a lot of time discussing how Broadcom is the undisputed king of custom chips for Meta and Google, right?
Yeah.
And how those deals represent the absolute future of their explosive growth.
Yes.
But we also established the paradox earlier. Those custom chips carry significantly lower profit margins than their standard software. So here is the multi-billion-dollar question.
Let's hear it.
If Broadcom successfully executes its master plan and completely dominates the custom chip market for the hyperscalers, will the sheer volume of those lower margin products eventually erode the very 40% operating margin that made Wall Street fall in love with them in the first place? can they actually survive their own success?
Man, that paradox is exactly what every major institutional investor is quietly trying to model out right now.
And that is exactly where we will leave it for today. Remember, navigating these charts, breaking down the debt-to-equity ratios, and tracking the insiders it takes a village. We laid out the fundamental data and the technical realities. But you have to make the final call for your own portfolio.
Absolutely.
So hit the like button, subscribe to the channel, and jump into the YouTube comments right now. Tell us your strategy. Are you buying the AI supercycle dip? Are you selling alongside the Broadcom executives? Or are you just holding tight through the incoming volatility?
We'd love to know.
Remember, this deep dive was purely an educational look at the source material, definitely not financial advice. Keep your head on a swivel out there, and we'll catch you on the next deep dive.